Hello, everybody. My name is Les Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. People think about taxes in March or April because it's an unpleasant subject, but keep in mind you need to take action during and before the end of the calendar year the taxes are being done for. Before the end of the 2022 calendar year, here's some things to consider. Number one, check out how much income and capital gains you will have this year and try to predict those for the next year. And consider selling investments this year or delaying the sale until next year, depending on which year you will have less income. If both years have roughly the same amount of income, you may wish to delay selling something that has appreciated until next year to have to pay the taxes just a year later. Number three, if you need to pull money out of a TFSA in the next few months, do it now so you'll get the limit back in a couple of weeks. Number four, rebalance your investments where investments are in different proportions than you had planned. So, for example, if your portfolio was supposed to be 60% stocks and 40% bonds, and now it's 70-30, sell the stocks and use that money to buy the cheap bonds. This sells high and buys low for your portfolio, but it also reestablishes the desired risk profile, possibly reducing risk that you were not prepared to take. Number five, if you need to rebalance your investments or you have had significant capital gains this year, consider the tax loss selling strategy. And you can see this in a previous video. And take into account items in number one. Note that this only works for non-registered, also known as cash accounts. So tax loss selling or harvesting lets you realize losses to offset the capital gains. Tax loss selling usually takes place at year end when an investor knows his or her net taxable gains for the year. Capital losses realized during the year offset capital gains realized during the year for a net capital gain or loss. A net capital gain is taxable in the year. A net capital loss may be carried back 3 years or forward indefinitely to apply against capital gains. When tax loss selling, the selling transaction must settle before the last business day of the year. So given a 3-day settlement period, this implies the deadline is before Christmas Eve, but why push it? In addition, you should be aware of the superficial loss rules. For example, do not repurchase the losers within 30 days before or after the sale. So consider purchasing similar but not identical securities. If you sell a security to trigger a loss, you or an affiliate person, for example, your spouse, a corporation you control, or a trust where you have major beneficial interest, including an RRSP, if you purchase the quote identical security within 30 days before or after the sale date, that person still owns that security 30 calendar days after the sale date. Then the capital loss is denied to you and added to the cost base of the person who bought it. This rule also applies if you or the affiliated person buys an option or a right to buy the security that was sold. For example, shares of competing companies within an industry should not be considered identical securities, while index funds which track the same index would be considered identical securities for purposes of the superficial loss rules. Please note that the capital loss will be denied if the buyer of the property is an RSP under which the seller or seller's spouse or common law partner is the annuitant. Therefore, swapping or contributing eligible securities to an RSP will also result in the denial of a capital loss, even though the accrued capital gain would be taxable. The idea of a tax loss harvesting is to think of the stock as being worth whatever it is at the data at the time, with you being able to take some advantage now of the loss. If you think it will recover, you can buy back later, And if it goes up, you'll worry about the capital gain taxes later when you're ready to sell it. If you don't think it will recover, the advantage of the tax loss and the use the money from the sale on something you do think will go up. There's no point holding on to it hoping it will recover just so you feel better about your investing decision, since it will just get worse as it goes down. Number 6, if you are looking at buying mutual funds at this time of the year, you will want to delay until January. Mutual funds make distributions by law of any gains they have had internally. And while it isn't actual cash and doesn't affect the share price in the long run, you get taxed on a distribution without receiving any benefit. So avoid big lump sum purchases of mutual funds. Number 7, get ready for RRSP season. If you need to buy more RRSPs for 2022, with the deadline being usually end of February, and consider starting a monthly purchase plan for your RRSPs rather than during quote RRSP season, so you get the money appreciating all year. Number 8, in case your payroll department doesn't know about your RRSP purchases, provide proof of the RSPs you'll be buying and fill out a T1213 request to reduce tax deductions at source form in January, so the CRA can send you a letter to pass on to your payroll department so they know to withhold less taxes from you. This way, you aren't giving the government an interest-free loan all year with a big tax refund at the end. Note that when you do your taxes the following year, everything will work out exactly the same. It's just the time value of the money. Number 9, if you have RESPs for your child, try to make sure to contribute the $2,500 to max out the 20% government grant under the Canada Education Savings Grant, CESG program at $500. You can catch up next year, but where entitlement is carried forward, the total CESG per beneficiary per year is capped at 1,000 or 20% of the unused CESG room, whichever is less. So do it every year. Number 10, if you plan to do any charitable giving or have other tax deductions you can trigger, do so now to get the tax credit a year sooner. And number 11, I'd like to give you some checklists for the new year, which are valid at any time, but you may wish to lump them in with all the other checks you're doing. Firstly, asset and debt issues. Have your investment goals or your risk tolerance changed? Do you need to be more or less conservative and thus need your portfolio to reflect that? Review your current allocation of assets, stocks, bonds, cash, real estate, etc., in your portfolio and the diversification of your stock holdings / mutual funds, and rebalance as required. If you have recently had expected expenses, did they impact your emergency fund? Did your situation change so you need a bigger or smaller emergency fund, such as switching to contracting from permanent employment? Experts suggest 3 to 6 months of bill payments. Are there high levels of cash in any accounts? If so, consider the following. The CDIC insurance limit is $100,000 per account type per insured bank. Note that investments like mutual funds, ETF stocks, or crypto are not insured, only savings account, including term deposits. Interest rates on the cash may be higher elsewhere. So, do you maintain a concentrated position in a single investment? If so, consider strategies to mitigate the risk by diversifying. Have you acquired or sold major assets or property? If you own a business, have there been any changes to the business? If so, consider the following. If you purchased new property or equipment, there could be an opportunity to depreciate it for tax purposes. If you hired new employees, consider reviewing the employee benefits, including your retirement plan design. Your business structure may need to be verified in light of any recent tax reform. Do you anticipate any significant expenses in the near future? Did you incur any new debts, auto loans, student loans? Have the interest rates on any of your debts changed? Do you need to review your credit score? Could there be assets that you may be forgetting? If so, consider the following. Confirm the interest rates on your debts and explore these options to reduce interest rates. Try to negotiate your interest rate with your credit card provider, get a balance transfer card, inquire about a home loan equity line of credit. Investigate debt consolidation. Review the points feature on credit cards and the miles with airlines. Search government agencies and unclaimed property sites that are run by many provincial treasurers. Calculate the maximum amount you can put towards debt repayment every month and commit to a strict repayment plan. No excuses. Pay the required minimum payment on all your debts and apply any leftover cash to the highest interest rate debt, which would generally be credit cards. Secondly, let's consider some cash flow issues. Has there been a change to your cash flow or budget? If so, consider how this will impact your financial situation. Has there been a change to your employment? Do you need to adjust how much you are saving? Do you max out your salary deferrals to your employer retirement plan but want to save more? If so, consider the following. You may be able to make a TFSA contribution if you have a contribution limit remaining. Keeping in mind January 1st, you get an extra $6,500 limit, plus any withdrawals in 2022 will have recycled back into your limit. If your employer's plan allows after-tax contributions, you can make a non-registered account investment as well. If you have income from self-employment, other opportunities for investing may be available, such as a company RRSP or company pensions if you created these for yourself. If you are taking distributions from any accounts, do you need to review your rate of withdrawal? Since you are subject to required minimum distributions in your RIF once you have reached the age of 71, are you prepared to satisfy the RMD before December 31st? Do you need to review your employee benefits to ensure that you are taking advantage of what your employer offers? Massages, various other things that your employer is paying for anyway. Do you have family members that will attend college or university? If so, consider funding an RESP. Do you use credit cards? If so, consider if there are any cards providing better benefits, features, points, etc. than the current card that you use. Review your monthly expenses for 2022 and identify expenses such as dining out or travel that were too high and what you could do to reduce them in 2023. Review your mortgage terms and renewal date and prepare for higher payments or adjust amortization. If you aren't sure where your money went in 2022, make sure you get a system in place like a budget to track your expenses for 2023. I like to compare my spending against the budget. It's very easy in my Quicken software, and I can identify where I went wrong. Also, explore opportunities to increase income. There are several options. Working overtime, if this is available, get a part-time job, or take in a renter or a boarder, such as an international student. If your living situation allows, clean out your garage or basement and sell anything you no longer need. You could also use your card to make money with DoorDash or Uber. Thirdly, let's look at some insurance planning issues that you can take a look at. Do you need to review your life insurance and/or long-term care insurance needs and any existing coverage? Have there been any changes in compensation, new dependents, or new liabilities? If so, consider changing the amount of life insurance or disability coverage that you carry. Have there been any changes to your real estate holdings that could impact your property and casualty insurance, such as a pool or a new structure? Have there been any changes to your health situation that warrant a review of your health/disability benefits? Fourthly, let's take a look at long-term planning issues. Have there been any changes to your financial or life goals? Do your beneficiaries need to be reviewed and possibly updated for your non-probate assets like life insurance? On other accounts that have a beneficiary listed, have there been any changes to your family, marriage, divorce, birth, death, illness? If so, consider revisiting your estate plan, meaning your will. Make sure you adjust it for any new assets or life changes, such as birth, changes to your last wishes, and ensure your beneficiaries are up to date. If you don't have a will, get one. It can often be done online with little cost or difficulty and will avoid a real mess if you die without one. Part of year-end investing checkup is making sure that you're setting yourself up for success in the next year, like automating your investing or revisiting the amount you're auto investing if you are currently doing so. Automatic investing makes it certain that you will actually invest. Review your progress toward the goals in your current retirement plan. Determine the actual amount you put towards retirement in 2022 and confirm that your goals are still achievable and realistic. Many factors affect retirement: income, inflation, cost of living, investment returns, home prices, retirement lifestyle expectations, etc. You must reassess and adjust your retirement plan regularly. And lastly, let's look at some tax planning issues. Were there any surprises on your tax return from last year? Did you receive a large tax refund or needed to pay a large amount when filing your return? If so, consider changing your withholding and or making estimated payments. You may be receiving significant windfalls that could impact your taxes. Inheritance, RSU, which is restricted fund units, vesting, stock options, bonuses. Do you expect your income to change in the near future? If so, consider strategies to minimize your tax liability. Do you have any unrealized gains, losses, or carry forwards from prior years? Do you need to determine cost basis for any assets that you own? Do you plan to make any charitable gifts? If so, consider the following. Fund gifts with appreciated securities instead of selling them first and gifting the cash for tax efficiency. The charity will get the full amount of the security and you will get a tax deduction for the full amount of the security as well, rather than paying taxes on the appreciation and the charity getting a smaller amount in cash and you getting a smaller tax deduction. Use bunching techniques to maximize the tax deduction from charitable gifts. And lastly, analyze returns and fees on your investments. You should be doing this throughout the year, but end of the year is as good a time as any. Make sure you know exactly what you are invested in, how these investments have performed over the last year, and the annual fees that you are paying. Fees may be built into a fund like an MER or tacked on by your financial institution or advisor. And always check to see how your investments are doing against their benchmarks. So I hope this has been a useful all-around checklist for things to consider that may have changed in the past year and need adjustment. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.